Welcome to this video. Today I'm going to show you how this intrinsic value calculator works. This calculator is a discounted cash flow calculator based on Warren Buffett's owner earnings. And once you understand how this works, you will be able to calculate the true value per share of a company yourself. So without further ado, let's get started. So what is a discounted cash flow model based on owner's earnings? Well, the first thing we wanted to talk about is about this sentence here. Money today is more valuable than money tomorrow. This is a really important concept, one of my favorite rules of money. Money received in the future is less valuable than received today. You can apply this to many things in life, but this is also the reason why, for example, subscription models is like when you pay per month, it's always more expensive than if you pay per year because they want the money right now. For example, would you prefer to have $100 today, or or $100 next year? You want it today because you can use it, you can invest it, you can do things with it. But if I would say $110 next year, or $100 today, you still prefer I want $100 today because it's more valuable today. But if you say $200, then maybe you want to wait a year. A small example of a lemonade stand is a simple business example. And this lemonade stand makes $100 profit annually. So after cost, this is the net profit, the earnings. And this is the same, we're going to talk later about this, the owner's earnings of Warren Buffett. What's left for the stock owner. This is what left in your pocket. So after a year, you have $100 and it will exist for around 10 years. So what's the present value today? Think about it. What do you think? Based on this information, would you value the business? Give a second to think about it, pause the video. Now let's find the answer of what the present value of this lemonade stand actually is. So in year one, it makes $100. In year two, it makes $100. In year three, it makes $100. Every year, it makes $100. So you could think that the present value is 10 times $100 is $1,000. So usually you would say it's worth $1,000. But is it really worth $1,000? Well, not in reality, because like you remember, right? The money received in the future is less valuable than received today. For example, the money you received after 10 years, because what's received after 10 years is less valuable than if you receive it today. So you need to have a discount rate. For this example, we're going to use a 5% discount rate. And so here we can read a 5% discount rate. So what's going on right now? $100 received in year one is in today. So the money is not received in the first day, but at the end of the year. So what you receive today is the value of today is $95. Because, okay, here you can show the formula. The present value is 100 divided by 1 plus 0.05 to the power of 1 because it's the first year. And that's because it's 5%, so it's $95. Year 2 to the power of 2, $90. Year 3, 86. So you see that every year it becomes less valuable because it's more in the future. So this $100 will be less value. So how do we calculate the present value? We calculate the discounted cash flow is this number for each year. We make a sum and we sum everything up. So we count this plus this plus this plus this, and everything plus, you will receive a company value of $772. That's the value of the company, of this lemonade stand. So not $1,000, but $772. So let's remove the discount rate for a second. And we're back to the year $100, everything $100. But now the lemonade stand is innovating in a better machine to make lemonade, and they're more efficient and profitable, and they will be more profitable in the future. So people believe in this company, and these earnings will grow every year by 10%. So every year it's tempting. Year one, you make $100, year day 110, then 10% for that, 121. So it compounds like an investment would be. In year 10, you make $235. So if you add everything up, you come off $1,593. But of course, we need to discount everything to present value. And we're going to use the same 5% discount rate. So you have now basically the same formula. You divide it by 1.05 to the power of which year it is. So 1, 2, 3. For example, in year 10, the $235 is, and discounted to present value is 1.05 to the power of 10, is $144.76. So let's count everything up from every year, and that's the total intrinsic value based on these inputs. And then we have a total company value of $1,184.67. This is basically how a discounted cash flow model works. We can apply this model to real companies to find its true value per share. And we're going to do that now with Tesla and find out whether it's cheap or expensive. So the owner earnings formula is like this. Owner's earnings is net income plus depreciation and amortization plus other non-cash items minus capital expenditures. Tesla's trading right now at $325. So we're going to find out whether this is cheap or expensive. We are going to use this intrinsic value calculator to find the true value per share of Tesla. And it uses the same principle like the lemonade stand. So the stock name is Tesla. The owner earnings is net income plus depreciation plus other non-cash items minus capital expenditure. And that is basically the earnings like what's left for the stockholders, similar as the earnings from the lemonade stand. Every year, discount to present value, and then count everything up, and that's the intrinsic value. You divide it by the amount of shares, you have the intrinsic value per share. You also need to fill in the net debt, so whether it says debt or positive cash flow, add or subtract from the total discounted cash flow. Then you have the current market cap, you have the shares outstanding, then the earnings growth rate, like type in how much it will grow in the future, and then in this calculator, here we can read for the initial 5 years, it applies the earnings growth rate you provide. For the subsequent 15 years, year 6 to 20, the growth rates automatically half reflect for a more conservative mature growth phase, which means that you get a more conservative value, which is it's good once you try to find a true value of a company. And then, of course, the discount rate, we're going to use 8% for this stock. So let's get started to find its true value and fill in the numbers on this calculator. Okay, let's first look at the net income of the company. Always do the TTM, which means trailing 12 months, the last 12 months. Everything is nominated in billions. And we can see, we can find it in the income statement, and we can use platforms like TradingView or Yahoo Finance. I like TradingView because they nominate everything in billions, and Yahoo Finance in thousands. So you need, if you use Yahoo Finance, you need to be, you need to understand that you need to fill in this calculate everything in billions. So let's use TradingView for this example. Here's net income in the income statement, and we can look here at TTM. This is the last column, and it says 6.37 billion. So we go back and we fill in 6.37 billion. Let's look at depreciation and amortization, which is fine in the cash flow statement operating activities section. So let's go to cash flow statement, cash flow from operating activities. And we can see here depreciation and amortization, TTM 5. Here we can see 5.57 billion. We can put it in 5.57 billion. So this plus the other cash items. This is also fine in the cash flow statement. So non-cash items, you can see here, it's $2.21 billion. So we can add that here. And now we deduct the capital expenditures. Here are like cash from investing activities, capital expenditures, TTM minus 10.06. So you fill in minus 10.06. And then the net debt is always in the balance sheet. You can always press information in the balance sheet. We go back, go to the balance sheet, net debt. Make sure that you now use quarterly, you use the last quarter. So quarter 1, 2025, that's the last one you can find. So it's minus 24.28. Minus 24.28. Now look at the current market cap. You can just find it on Finviz. Go to Finviz, type in Tesla. And here we can see the market cap 1046.37. Just copy. And here we can just put in 1046.37.22. Shares outstanding 3.22. You can find everything on Finvis here. And now let's talk about the earnings growth rate, the earnings per share for the next 5 years. This is the estimated percentage growth of a company's earnings over the next 5 years. It's a forward-looking projection, not found on standard financial statements. So let's start with Finvis again. So the earnings per share next 5 years is according to Finvis 18.68%. Next year they even think it's going to be 52, but for the 5 years it's 18.68%. You can also type in Tesla. They say 19% here. Expected earnings per share growth 3 to 5 years. 19%. Okay, let's go back and then go to growth. And here we can see earnings per share for long term 3 to 5 years, 21%. So let's just take an average of 19% for our estimated value. If we go back to our calculator, we go to 90%. Remember, this is for the next 5 years, it will grow by 90%, but the last 15 years, because it's a 20-year discounted cash flow method, it halves this return. In short, the first 5 years, it's going to grow with 19%, and the last 15 years, it's going to halve, so 9.5% every year, which is a more conservative approach to value a business, which gives us investors a margin of safety. Now let's talk about the discount rate. Here we can see that the rate used to calculate the present value of future cash flows and indication. So we are going to use an 8% discounted rate, which is high, but it's necessary for double-digit growth stocks. This gives us also a bit of a margin of safety because we discount everything with 8%, so we have a more conservative value. Now when we fill all the numbers, we can just calculate the intrinsic value. So let's do it. Here we can see that based on this calculator, it's actually overvalued by 23% with a potential downside of 19% from today's price. The intrinsic value, 847 billion, significantly lower than the market cap. So it's a $1 trillion the market cap, and according to this calculator, it's overvalued. So the true value per share is 263. If we look here at Tesla right now, it's $325. So it's overvalued right now according to this approach. So if you buy right now Tesla, you're not buying a bargain. It's actually quite expensive. Okay, now we're looking at the weekly charts of Tesla, and I put here a line. It's the true value per share, 263.20. That's what we calculated, and it's now at $3 to $5. So now we're looking at the weekly candles of Tesla, and we calculated that the true value per share is 263.20. And it's now trading at 325.31 in dollars. So we can see it's slightly overvalued, but actually not by that much, which is interesting. I personally hold like 3% or something, 3-4% of my portfolio is Tesla. I'm comfortable holding this stock and not trying to predict that it will go down here and then it will go up. I think it looks pretty bullish if we look at the technical analysis. Then we can see that it's making higher lows and higher highs, which is a sign of a strong uptrend. I think Tesla has been in a sideways trend for 4 or 5 years, and I think it's time that it will explode to the upside. Let's look here. We can put a trend line like here, and we can pull it all the way back. We can try to connect these bottoms, but here we can put a trend line that touches all these things. So this is also a strong support. I would say that I will do nothing. I will just keep my 3-4% in Tesla. If it drops all the way, I will buy one more position to make it 4% again once it touches this support line here. Or when it's close to 200 simple moving average around here, I will add more, and then I will just not touch it anymore. Even if it goes lower, I'm not going to try to find the exact bottom. So yeah, that's what I would do. I think don't bet against this stock. I think there's still a lot of potential upside for Tesla. I think it's slightly overvalued, like we calculated. So I would not be comfortable putting like a big position in Tesla. I will not be comfortable with that. But I think having a small position in Tesla in your portfolio can be very profitable in the future. Always do your own research. Make sure you always keep your cash reserve. Thank you so much for watching. I hope you learned something, and see you in the next video.